I guess maybe the one thing we'll start off with is whether or not you feel good about this seasonably strong time of year for stocks right now. Are we down enough to where we could see a nice year-end rally?
Hi, Dom. Nice to see you, too. I think that we had some good momentum a couple of weeks ago that gave us a sense that there was going to be a real rally at the end of the year. We had that day where the CPI came in a bit light, and S&P was up 5.5%, the NASDAQ almost 8%. We've had trouble following up on that. I mean, what's important to look at, perhaps 50-day moving average still above it for the S&P, but right on the brink. So we need a couple of strong days in order to carry this forward. It would be great if we saw that this week, but it's a very short trading week.
All right, so with that short trading week, there have to be certain parts of the market that, in the coming days and weeks as we head towards this seasonably strong time of the year, are going to be more on your radar than others. Take us through your picks, because you are a stock picker by trade. I'd like to know what's on that list.
Sure. Well, the first thing I would say is it's a little early to be too aggressive on adding risk. The market has been extremely risk averse all year, but at this level, and there are a number of stocks that have had so much sort of battering ram at them all year that we think they represent attractive opportunities that you have to match with those that are more defensive. So on the slight risk on trade, we'd add some Meta, some Google, Alphabet. We'd probably add a little Adobe or Autodesk, one of those, perhaps Salesforce, CRM. These are stocks that have really come down tremendously. Meta sells for 10 times, a 10-time multiple if you exclude its cash. And these companies are starting to get religion. They've all talked about cost cutting and making an effort to improve their margins, showing more to the bottom line. They're activists in many of these technology stocks now. There are people coming at them from every direction. Google is an example where you're having major hedge funds say, we don't think that your structure is appropriate for the way we're looking at companies now. You need to bring more to the bootam line. So, yes, we see opportunities there. And then on the other side, we still have some defensive, safer names, O'Reilly Auto, Booz Allen Hamilton, American Express. Those are names that we like, Thermo Fisher, because they represent real steady cash flow earnings. They may not have the same pop if the market turns, but you need them on days where we're in this risk-off situation because no one knows what the Fed is going to do. We really hope that inflation begins to come down, and there are good signs of it, but it's not so obvious to the market.
So Carrie, before we let you go, we got a few moments left here. I've heard a lot about these auto parts retailers. O'Reilly is near record highs right now, but the same can't be said for Advanced Auto Parts. AAP is the complete opposite story. How do you pick between the two?
Well, it's interesting. We've owned O'Reilly for years, and we've trimmed it a couple of times because, as you said, it's been a great stock. It's not cheap anymore, but they have been able to expand their base and have been able to raise their prices some as their costs have gone up. They've been able to address the supply chain issue, and Advanced Auto hasn't been able to do that. They've struggled with having product and inventory, and that has meant consumers are unhappy. If you go and you need something for your car, you need it now. Can't leave the car unfixed.